decides to finance, they can go with debt financing or they can go with equity financing. Stocks are equity side. So if you decide to do equity financing as a company, then you would be issuing stocks. There are a lot of details we can talk about with stocks. So let's start looking at a few of those. The first thing deals with the types of stock that could be issued. You could issue common stock or you could issue preferred stock. Common, by the name itself, is the most common type of stock that you can issue. Preferred has a preference for a few things. So let's start with common though. The rights of common stock. If you purchase common stock, what would that entitle you to? Well, you would be able to vote for a company's board of directors. So when the board of directors is elected, you would be someone who votes to elect that board of directors, who would then run the company and make decisions for the company. You would also have a right to dividends. Now, we'll talk about dividends in a minute, but dividends are not required. Companies do not have to pay a dividend, but you do have a right to them if they are declared. Another right for common stockholders would be a right to assets in the case of liquidation of assets for a company. So let's say a company went out of business, they're liquidating all their assets. There's an order to which different people would get paid or would have those liquidated assets given to them. Creditors are first, and as we'll find out in a minute, preferred stock has a preference for that as well above common. But then common falls in line too, so they do have the right to share in that liquidation of assets. Sometimes common stock can have another right as well, but this is not one that every company has, and this is something called preemptive rights. Again, this is not universal, but if these rights exist, preemptive rights, that means that when new shares of stock are issued, those existing shareholders have a preemptive right to keep the same percentage of ownership that they had before those new shares were issued. So they could purchase additional shares to keep their same percentage ownership in the company overall. Again, that's not a universal right, but that is one that can be applicable to common stock. Preferred stock has a preference over some items. They have a preference over dividends. For one, they get paid first. They also have a preference to a liquidation of assets. Preferred stock, however, does not get to vote. They do not have voting rights. So that's one difference between common stock and preferred stock. Treasury stock is a special type of stock, and this is actually one that isn't issued, but one that comes back to the company. Treasury stock is your own company stock that is repurchased by the company. So if this was, I don't know, Apple, this would be Apple buying its own stock back from the market and holding it. Now, there's a lot of reasons why they might want to do this. Maybe they want to give that stock to their employees as a bonus. Or maybe they just want to purchase that to change the market price of their stock. They buy up a lot of the stock and there's not a lot that exists. It can cause the market price to go up of the existing stock. Now you can buy and sell treasury stocks. You could repurchase it for your company and hold it. You can also then sell it back in the market. Treasury stock is a contra equity. So when you see treasury stock in your equity section on the balance sheet, it will actually be deducted from the other equity items. It'll be at the bottom of your stockholders' equity section for a corporation. You'll have your common stock listed and your preferred stock. Some other paid-in capital accounts would be listed. And then you'd see less treasury stock because, again, it deducts from. It's a contra equity. You've repurchased your own, so you need to show that, again, that's a decrease there in your equities. How many shares? All right, so when we're talking about common stock, preferred stock, maybe we bought some back, so maybe we've got some of that treasury stock as well. How many shares are we really talking about, and who's got them, and where are they? So we need to know the distinction between authorized shares, issued shares, and outstanding shares. So when a company first forms or decides to issue shares, that's part of their corporate charter with the state in which they incorporated. and they are granted by the state a number of shares that they can offer for sale. And that's the amount that's authorized. So this is the maximum amount of shares that they could offer. It doesn't mean they have to sell them. They don't have to sell any. Let's say that you start a corporation and your state that you incorporate in authorizes you to sell, I don't know, 500,000 shares. That'd be great, and you could sell all of them tomorrow, but let's say you don't. You just decide, okay, I don't really want to sell any shares right now. I don't need any equity financing. That's fine too. You still have 500,000 shares authorized. You just haven't issued any, and you don't have any that is outstanding. Once you sell shares, a share of stock that has been sold at one point in time, then it becomes issued stock. So let's say that 500,000 shares, you sell 100,000 of those. Now you have 500,000 shares authorized and 100,000 shares have been issued. And they are also outstanding at that point. Outstanding stock is stock that is in the hands of an outside buyer. The difference between issued and outstanding is that treasury stock that we talked about. Treasury stock is not outstanding stock because the company owns it. So it isn't in the hands of someone else, it's in the company's hands. So it can't be outstanding. It has been issued though. At one point in time it was sold to someone outside of the company. So it has been issued stock, but it's no longer outstanding. Especially when we talk about dividends and paying dividends, we have to know how much is outstanding. We can't pay ourselves a dividend. So we don't pay dividends on, number one, we don't pay them on authorized, because what if, again, in the first scenario, all of them were authorized and none of them had ever been sold? We wouldn't want to pay dividends on authorized stock because nobody owns it. It's never been sold. If we were paying on issued, we'd be paying possibly ourselves some dividends, and we can't do that because treasury stock is included in issued. So if there's any treasury stock, we need to take that into account. So when we talk about paying dividends, we need to realize how much is outstanding. So if you kind of think of a bullseye, the authorized is the biggest ring. And as you move closer to the bullseye, that's where you get issued a little further in, and outstanding would be the bullseye. So it gets narrower as you move in through those definitions of what that means as far as what the stock is. So we mentioned dividends. What kind of dividends could we pay? We say, hey, thanks for being an investor with us. We want to give you something back. You could give them cash. You could give them stock. You could actually do a property dividend. I could give them a piece of equipment that we have, or I could give them land. You can give dividends of any type of asset if you really want to, but the most common is a cash dividend. And then also I can give stock, additional shares of stock as a dividend. Cash, obviously, I'm literally going to send them a check. And again, this one is the most common. Stock, I'm going to give them additional shares of stock. Now with a cash dividend, there's a couple of other things that we need to consider though. There's some requirements we need to meet. 3 specifically. 1, if I'm going to give out cash, I have to have enough cash to pay. So if I decide I'm going to pay $10,000 in a cash dividend, I better have at least $10,000 in my checking account. So I have to have that amount of cash. Also, I have to have that amount as a balance in retained earnings, a credit balance. So I really do have to have enough sitting in retained earnings. I can't have a deficit account, and I can't create a deficit by paying dividends. I have to be able to have a retained earnings balance. And then I also have to have approval of the board of directors. They have to approve the dividend, pass it, and then declare it. So if we meet all of these requirements and qualifications, then we can issue that cash dividend. So there's some dividend dates that we need to know. Date of declaration, date of record, and date of payment. So the board looks through and they say, okay, we want to pay a cash dividend. Do we have enough money? Do we have enough in retained earnings? Because remember, those are not the same. Retained earnings has nothing to do with cash necessarily at all. So you do have to check both. And they say we agree to it. Okay, so we're going to declare a dividend. When you declare the dividend, you're saying we are going to pay it, and that's the date in which you incur a liability for it. So you record that dividends account, and you record a dividends payable. Okay? Now you're not paying it that day, you're just declaring it. The next date is the date of record, and this is a date after the date of declaration in which you say, okay, when we declared it, we're going to pay dividends to all those that own the stock. Let's say you declared it on May 1st. We're going to pay it to everyone that owns the stock as of June 1st. June 1st is then the date of record. No journal entry is made on the date of record, but that's when I need to know who owns the stock on this date, because those are the people that are going to actually get the dividend. So even if it's declared on May 1st and you sell your stock on May the 2nd, you're not going to get a dividend because you didn't own it on the date of record. And then we also have the date of payment. Let's say July 1st is the date of payment. Well, if June 1st was the date of record and you sold your stock on June 15th, you're still going to get the dividend because you held it on the date of record. Date of payment's not till July the 1st. Date of payment, we do have a journal entry. That's where we actually pay it. So we decrease that liability we created, and we actually give them cash if it's a cash dividend. If this is stock, we still have these dividend dates, but instead of paying cash, I'm going to distribute or issue shares of stock to my shareholders instead of actually giving them a cash payment.